So distressed, how distressed are some of the assets that are out there?
You know, we are today, it looks like a wonderfully sedate world, right? High yield spreads, 350 basis points, technology, equity stocks are up, right?
Yeah.
So
Everything's awesome?
on the face of it, it's like ducks.
Ducks
gliding
on the water.
Yeah.
It's their legs are just like yeah.
It's, you know, so what people miss a little bit, there's $4 trillion of private equity assets invested in the ground. There's $5 trillion of people they have borrowed to make. And where we are today, high interest rates, a sluggish economy outside tech, Europe near recessionary, a wall of maturities over the next 3-4 years. So I think what you miss is, oh boy, there's a slog now to kind of work through this.
All right, so when does, and I'm looking at our live blog here on the Milken Conference, and that's one of the things that they highlighted, that you see the companies hitting that debt maturity wall. So when does it start to come undone? It
started. So, you know, when you look at what we do, if you use us as an example, right? Starting about 12 months ago, we started to speed up the pace of investing, right? So this is not like it's coming next year or something, because what happens is the maturity wall today is there's very little in 2024. In 2025, 26, 27 is $600-700 billion a year. $600-700 billion a year, and you've got to address it early.
Right.
So the maturity wall, people are addressing it. It started.
But you've seen some of the creative tactics now that we're starting to see some funds take to make sure that we don't see those defaults.
Right.
Whether it's doing selling to another fund, just peeling off a stake here and there. I wonder, like, what do you make of that in terms of the sustainability of that strategy and protecting those companies until, in theory, we get to the other side of whatever we're going through?
And it is, you know, private equity investors are really smart, and they wiggle.
Yeah.
Right? They're wiggling. But I think when we look at that world, how big it is, our view, there's $500 billion of what we would call adventurous financing, which is required, which will be there. They'll push it off, but they'll pay a pretty price for pushing it off, right? And there's $300 billion or so we estimate, which is going to be just like I give up.
And just to be clear, the values we're talking about too, those have been inflated because of some of these new agreements and some of these new extensions.
Yeah.
But it gets to the question, though, do we need, say, like a recession or some real huge economic shock to shake this out? If not, if we don't get that shock, you think this will still play out in your favor?
You know, our view would be, we don't really expect some headline-grabbing recession. There is a chance. There is tail risk in this economy. Our base case in the United States is it's a little bit of a slog.
Yeah.
And so we're not expecting, oh my gosh, there's a credit market crash or anything like this. But just to deal with what we have, you know, for somebody like us, we've got a broad set of skills, right? We don't just buy debt at 50 cents. We have the operating skills to fix it, to take control of a company, to manage it better. For somebody, when we buy assets, we own operating platforms to own the asset and to fix it. For somebody like us, it's really attractive.
Would you want to own commercial real estate assets though right now?
You know, we've been looking, the most interesting investment we probably made in commercial real estate, one of the two best investments we've ever made in a firm was in commercial real estate 2-3 years ago, right? But what I would tell you is, last 10 months, we are seeing that slide. We are in the process of making our first ones, but boy, you've got to be careful. You know, when you look at these office properties, there's $2 trillion of office mortgage debt in the US and Europe. But you don't know, is the occupancy, hey, it's 40%, how much money does it take? You've got a problem, you've got to be careful.